Howdy, folks, and welcome to the Daily Coin. My name is Rory, and today is Wednesday, January the 27th, 2015, and I have the very distinct honor and pleasure of welcoming back Mr. Bill Holter of the Holter Sinclair collaboration, and you can find all of his work over at jsmindset.com. How you doing today, Bill?
Good, Rory. How are you?
I'm doing all right. I'm very grateful to have you on the line today. And you just released late last night a fantastic piece titled Charts with More Words Than COMEX Has Registered Ounces. And I just want to dive right in and into this. I was going back over it this morning, and one of the paragraphs that really stood out to me was it's about halfway through it, and it goes something like this. And it says, in my opinion, a defining event is just about to happen because the Fed blinked and forced an unjustified rate hike. One of two things will happen. Either they stay the course and maybe hike again, in which case asset markets will implode to unrecognizable levels, or conversely, the Fed blinks again and actually does further QE and pushes rates negative. In this case, I believe they will finally get a reaction from money, the velocity of money. I believe the velocity of money will shoot straight up and probably to new high levels as, quote, non-credible, end quote, monetary policy will spook a run out of dollars. A reversal by the Fed will begin the game of hot potato where owners will want out of dollars while they still can. Now, is that going to, are they going, are the big banks, the too big to jail banks, are they going to be forced to pull some of their reserves out that they have parked at the Fed? Is that what you're implying? Or how do you see that playing out? I mean, what does that mean to me?
Well, the Fed, of course, everybody knows last month the Fed tightened for the first time in whatever it was, 7 or 8 years. And the market the markets, credit markets, equity markets all over the world have imploded since then, and particularly since the first of the year. And what I was trying to get at in that paragraph is that the Fed can stand pat or try to tighten more, in which case you're going to see a complete and outright implosion of everything. You'll see a deflationary event where everything comes down into a market closure, basically. And when it reopens, you'll see a reset where asset prices will be unrecognizable. Now, since the first of the year, there have been a couple of Fed governors or Fed presidents make mention of loosening. In other words, reversing the rate hike. And they actually talked about negative interest rates. And my thought is, if you see the Fed blink and they turn around and they say, oh, well, we made a mistake, we're not going to tighten, we're actually going to loosen, and we're going to do more QE, at that point, then you'll see a flight completely out of dollars because the Fed will have lost all credibility. We've seen foreigners over the last 12 months have dumped about $1 trillion worth of reserves. And that's not shown up on anybody's books, which tells me it has to be the Exchange Stabilization Fund because their books are private, they're closed. We never have seen them, we never will see them. So in effect, the Exchange Stabilization Fund is monetizing the U.S. Treasuries that are being sold by foreigners. My thought is if the Fed does loosen, that $1 trillion will become several trillion, and there will be no way to hide it. You'll see a run out of the dollar. And there will be your velocity as people try to spend their dollars before they become worthless.
That's called hyperinflation, isn't it?
Exactly.
And do you
See,
think,
the reserves, the dollars, the credit has already been printed as the fuel, the kindling wood, the firewood for the hyperinflation. All we need is a spark, and the spark very well could be and probably will be loss of credibility by the Fed.
okay, well, why hasn't China and especially Russia, why haven't they stepped up and done this already? I mean, in your, from what
They have. They have. They both have. Russia sold over 100 billion worth of treasuries, and China, I believe, sold something like 300 billion worth of treasuries. Their reserves, their treasury reserves, have in fact shrunk. I don't know, 7, 8, 10%, something like that over the last year. So yeah, China has stopped buying treasuries, and they're starting to leak out and liquidate some treasuries. We've not seen any movement in the treasury market because there was a buyer, and that buyer was the Exchange Stabilization Fund. So in effect, the U.S. is buying their own debt.
they're just shifting it from the left pocket to the right pocket.
Right, but not accounting for it.
Exactly.
There's been no accounting for $1 trillion worth of reserves that the world's central banks have been selling over the last year. There's been no accounting. And there's also been no market movement. And in a free market where we didn't have a clandestine, if you want to call it fake, buyer, rates we'd be over 3-4% already on 10-year treasuries. But rates didn't go up because the Exchange Stabilization Fund, in my opinion, was the buyer and soaked up all the selling.
How does the Fed get out of this trap? I mean, they seem to be trapped, or is that just am I off base there?
No, you're absolutely right. There's a two-word answer for how do they get out. They don't.
Okay.
There is no way out.
Okay.
Simple as that.
So why wouldn't, and I'm going to stay with this for just a second, Bill. I mean, why wouldn't China and Russia, why wouldn't they just flood the market to where there's no way that the exchange stabilization fund would be able to absorb it, or would they be able to absorb it? I mean, if China announced, we're going to release $500 billion worth of treasuries, and Russia says we're going to release the same amount.
Well, Russia doesn't have that much.
Well, I know they're about done with their holdings.
Right.
But I mean, they could come in and say we're gonna release everything that we have, and China say we're going to release $500 billion all in one day.
The very simple answer is that would not be good for China. It wouldn't be good for China because it would damage the price of their holdings, their existing holdings, and it would also end the game of China accumulating Western gold. They're doing this slowly so that they can accumulate gold. I mean, they've been accumulating 200, 250 tons of gold per month, and they've been draining it from the West. So why would they blow the game up while they're still being delivered gold?
Well,
now once they ask for or pay for gold and don't get a delivery, then the game's up. Then they'll blow the whole thing up.
Okay.
Because they know their treasuries are worthless.
Yes.
But right now they can use the treasuries to buy gold.
And that brings us back to the COMEX and where they're at, and how the COMEX, according to your research, Bill, in this article, they only have a mere 73,000 ounces of gold versus 11.4 million ounces of contractual deliveries. How does that add up?
There's 114,000 contracts still left for
February.
If you go back, let's go back a month into December. The December contract, 6 tons or 8 tons that were actually standing for delivery, and there was 8-point-something tons that COMEX had in the registered category. And they never delivered any of that. there was zero movement of gold that we could see until yesterday. And yesterday they delivered 201,000 ounces. The first thing I'm going to say is it makes no sense whatsoever. If that gold was available on January 1st to deliver, it would have been delivered January 1st. And the reason being, the short has had to pay, today's what, the 26th of January, they've had to pay 26 days worth of storage to wait this long. So if the gold was there and they're getting the exact, they're selling it for the exact same price, there's no advantage to waiting. There's only a disadvantage to waiting, and that's paying 26 days worth of
storage fees.
Storage fees, exactly. So that was the first thing that was really squirrely, was that no gold got delivered. Now, last night we saw 201,000 ounces delivered, and that leaves them with 2.3 tons, or I think the number is 74,000 ounces. So they have 74,000 ounces left in the registered category, with 114,000 contracts still open for February. That's 11.4 million ounces. Now that's going to bleed down. You'll probably see it bleed down to, I don't know, maybe 1 million ounces, maybe 600,000 ounces. I don't know, but 74,000 ounces is not going to cover it. And if you look at 74,000 ounces, that number represents roughly $80 million. $80 million is nothing. It's zero. And you've got an inventory of $80 million that is the pricing mechanism for gold all over the world. Something's wrong with that picture.
Very wrong. And that brings me to the next question, as far as going back to China. I mean, they've been saying for a long while that they're going to introduce a global pricing mechanism for gold and for silver. And they're
in the process of doing that right now via the Shanghai Exchange.
Right.
And as long as we're talking about the Shanghai Exchange, China made huge news last night by saying that they will no longer publish the amount of gold that's being delivered out of the Shanghai Exchange each month. And as I just mentioned, they've been delivering out 200 to 250 tons per month. And let's compare that to COMEX that has 2.3 tons available for delivery.
Right.
So China is delivering out each and every month 100 times what COMEX says they have available for delivery.
See, something is very wrong there.
Yeah, and there's, that very well could be your defining event or whatever. I mean, it could come from so many different angles. It's mind-boggling. I was shown a chart this morning of, I forget who it was. It might have been Glencore or some other commodity house. The CDS, the credit default swap on them, and how it's exploding. And the thought came to my mind: whoever sold these, how in the world are they ever going to be able to pay off? And then you go one step further. There's credit default swaps on U.S. Treasuries. That's the biggest joke of all. If the U.S. Treasury defaulted, which they really can't because they can print, but if they were to default, who in the world could possibly pay the credit default swaps on a U.S. government or U.S. Treasury bankruptcy? I mean, that's a joke.
Yes.
Who in the right mind would play that game on either side? You can't. It can't be paid, and you can't receive the winnings. It's a stupid game.
Well, I mean, it's just a shell game, though, right?
It's a complete shell game. It's an air game.
I mean,
it's an air game on both sides. The only thing you can do is trade it while it's still up and running. That's, in my view, that's the only thing. And that's really, in my view, that's what COMEX is. COMEX is not it's not an end game thing, because in the end, they're not going to make full delivery on all the demands.
No, they
They can't.
can't. They
According to
can't.
their own numbers, they can't.
Right. Right. It's impossible. It's physically impossible. So, got physical?
Yeah, exactly.
and,
Either you
and
have it in hand or you don't have it.
exactly. And you're a broker, Bill. You actually,
Yeah, I broker gold and silver. I do my business, do my trades through Miles Franklin. I kept my relationship with them.
yes. And what have you been seeing as far as, is there any pickup? Is there any change? Are you seeing new customers coming in? How's that
There was
working out?
a drop in business. I want to say it was October, November on the retail side, and we've seen it pick up through December and the early part of January. Um, it's not as brisk as it was from the, call it, June to September period. That was very, very brisk. I mean, there was huge amounts of business being done.
Primarily gold or silver?
Um, I can't speak for the firm itself. I can tell you I did a lot of silver, and that was on my advice because I think
Okay.
silver is far undervalued to gold.
Yes.
At 75-to-1 ratio, I think it's a no-brainer that you own silver over gold. And plus, if you're worried about confiscation, you obviously got to look to silver because that would not first and foremost be confiscated. It would be gold.
Yes.
And I'm not saying that's going to happen, but to get one step further away from it, I think you look at silver. But the fact that the ratio is 75-to-1 and silver comes out of the ground at 10-to-1 tells you it's 7.5 times undervalued.
Right. Yeah. And I like those odds. That's actually what got me into the market was the gold silver ratio. I mean, that was my first exchange was into silver, and it was based on, at the time it was at 42-to-1, and I had learned at the time that the historical ratio was somewhere around 16-to-1, and
Right.
at that time it was coming out of the ground at around 11 or 12-to-1, and now that's dropped.
Right now it's just under 10-to-1.
Yes, it's under 10-to-1. So I mean,
yeah, Jim Sinclair coined the phrase "silver will be gold on steroids," and I absolutely agree with that.
yes. And speaking of Jim, I know that you guys are making some changes over there at jsmindset.com, and if you would, Bill, just give us a brief description of what's happening.
The existing site is going to remain. We'll continue to post articles that we think are of interest and important to read. We're going to go to a premium site format. My work will be on the premium side. Jim's comments to articles will be on the premium side, and we plan to once or twice a month kind of sit down in an interview format or a sitting across the table type format and take subscriber questions. I don't know, 4, 5, 6 subscriber questions, and just talk about them. So that'll also be on the subscriber side. We're talking about a nominal amount. The annual subscription is going to be $125. We will have a pre-registration period where your cost for a year is $100. And I would think if we do a dozen or 18, 20 crosstalks between the two of us, that's more than worth the price of admission right there.
Absolutely.
So, and I'll be my work, which is carried on a dozen or more websites. I plan to write 2, maybe 3 articles per month, which are public, but my work will be found on the premium side of the website.
Okay. Now, when you say public, are they going to be? You're talking about a couple of articles a month that will be released to the public?
Exactly. They'll be released, and a dozen or more websites that carry my work will publish those. Hopefully, I mean,
I will.
they've been publishing my work for quite a few years now, and I'll send them out to the same sources. So
Okay.
wherever they're being published now, the 2 or 3 articles per month hopefully will be published.
Now, will you continue doing interviews like we're doing today?
Yeah, I do plan to do
Fewer?
probably 15, 18 interviews over the course of the year. So,
Okay.
I'm not going to make myself scarce, but Jim and I will be doing interviews with each other, which I think will be, I think they're going to be very interesting.
I would agree with that wholeheartedly. And I want to jump back into the markets, Bill. And I was reading yesterday, and according to Morgan Stanley, the oil price downturn is now deeper and longer than any of the previous downturns since 1970. The oil price is in uncharted territory. With oil and gas showing clear signs of deflation, why aren't we seeing prices of retail and food and other goods drop with shipping costs going down? What's going on with that? There seems to be a disconnect.
One thing I would tell you is that if you saw the prices of everyday goods drop, there's so much credit in the system that you'd see a credit implosion. I mean, if everything did what oil did, the whole system, the system would be shut down right now.
Okay.
Markets would be closed, distribution, Walmart shelves would be empty and the stores would be closed. And the reason being because the credit for these businesses to operate, those are embedded fixed costs. And if you had an 80% drop, which from $150 to $30 on oil, if you had an 80% drop of all goods, the credit remains. There's no way the debt service would be able to be paid, and you'd see a complete closure. And that's what you're actually starting to see in the oil patch. You're starting to see dividend cuts. You're starting to see bond defaults, and we will see some bankruptcies.
Well, that's already happening, isn't it? I mean, some of these companies are.
It's already happening, and you're also going to see some of these credit default swaps trigger and got your Lehman moment.
Okay. Does your research show?
No, it's unwinding. That's what you're watching. You're watching the credit structure unwind. That's what this is. This is it. It's over.
This is it. It's over.
The question of how fast it collapses, and we'll see some bounces, but there will be a time when there's not a final bounce.
Isn't this all by design? I mean, isn't the Federal Reserve, who is they've been the maestros of all this. They're the ones that implemented all of this nightmare that we're living through. I mean, isn't this part of the design as far as their mandate? I mean, they raised rates at the exact wrong moment, and it couldn't. Their timing could not have been any worse.
Well, Rory, time in the last 8 years, if they raised rates, was the exact wrong moment.
Okay. Well, true.
I mean, think about it. They cannot raise rates. They can't raise rates. You can't raise rates on a system that's over indebted. And they painted themselves in a corner. Now, I've written since 2007, since I started writing. End of 2007, I said, the policies that they're putting in place can't be by mistake. This has to, what's going on has to be on purpose. There's no one in their right mind would put the policies in place that they have because they're steering us into the ditch. It's not like we're going off the road into a ditch by mistake.
Right. I wanted to change gears just a little bit, and with the mining operations, that they're collapsing. I mean, and that's on a global scale.
Yes.
I mean, how are we going to be able to supply new stocks of metals? I mean, base metals, precious metals, rare earths, etc.
It's all going to drop 20, 30, 40%.
we're
the
already
supply.
starting to see that now. And
Yes.
are we going to? I mean, by the end of this year, I mean, wouldn't you agree that that supplies of all metals, whether it's copper or gold, that those supplies are going to start getting tight?
Well, let me finish by saying this, Rory. Uh, by the end of this year, supply and demand of everything will matter,
Okay.
and it doesn't. It doesn't right now. It does in oil. You're seeing an oversupply of oil, but you're not seeing true supply and demand in silver and gold. Uh, you're going to see the supplies of all sorts of commodities dry up because prices have collapsed, and there's no profit, there's no incentive to produce them.
And with the
So you'll see
BDI,
operations shut down.
right, and Baltic Dry Index has collapsed. Shanghai Containerized Freight Index has
Well, the
collapsed.
Baltic Dry Index was over 10,000 at one point.
Right, and not
Now it's
too
what,
long ago.
370 or 80. That's a 96+% drop in freight rates. That's how would you like to own a freighter at this point?
Be going broke
Right.
or shutting it down. One, sink it, make a reef out of it. Oh my
That too.
goodness. Well, Bill, is there anything we should leave the audience with today?
Just prepare yourself for what's coming, and what's coming is a breakdown of life as we knew it. How long the breakdown is going to last, I don't know. My fear is that you see total social upheaval, social unrest.
There's
When
a
I
lot
say
of
prepare, think about what you would need if you had a snowstorm that lasted 2 or 3 months or 6 months, where you couldn't get out, and there was no, you had no services, you had no Walmarts were closed, etc. Because I think that's going to happen. I think credit collapsing, and I wrote 2 pieces yesterday. One of them was about credit collapsing. That is going to affect the distribution of goods. So goods are at some point in time going to be very hard, if not impossible, to procure.
So if you don't have it, if you don't hold it, you don't own it, and you ain't gonna be able to get it.
That's correct.
Okay. Do you see? You said you see civil unrest, and there's a lot of people that are talking about that. And do you think that we're going to see full scale? Do you think that the world war that we're currently experiencing, do you see that expanding and growing larger? Do you see China stepping up? Do you see, or is there just going to be some type of black swan swooping in from the nether reaches of the Twilight Zone that kind of sets everything off?
Well, you have two factions, and I've written several times that I believe the West wants a war to hide what's coming. In other
Yes.
words, something to point at, so they can point at it and they can say, well, our policies were working, but the war came, and that's the reason for the bad times. And sadly, from the time I was a kid, I mean, it was reversed. Sadly, it's the East that seems to be level-headed. I mean, we've poked Russia and poked Putin how many times and not gotten a response. And I don't think that's out of weakness. I think that's out of they don't want a world war.
Right. They don't. I don't think China does either. It's not in their best interest.
No, not at all.
I mean, the
I
U.S.
mean, internally they have they're going to have big problems internally. They're at the point of laying off 400,000 steel workers.
Right.
So they're going to have some internal social unrest. But it just makes sense. I mean, you see the banking system close. People are going to be angry.
Yes, they are.
And when people are hungry, they'll do whatever they need to do to get food.
That they will.
It's all common sense.
That they will. Well, Bill, I'm not going to take up any more of your time, and I certainly appreciate it. And once again, been speaking with Mr. Bill Holter of the Holter Sinclair Collaboration. You can find his work over at jsmindset.com. And like I said earlier, we publish all of Bill's work that we can find, his interviews, his writings, and everything else. So I certainly appreciate all your time today, Bill.
Thank you, Rory. My pleasure.
Well, hopefully we can do this again in the future. And
we'll do it.
All right, buddy. Have a good afternoon.
You too.
Thank you.